Hello, everybody, and welcome to our second edition of the RPAG Scoop for July. My name is Ashley Passo, a marketing specialist here at RPAG, and I am very excited to announce our very first speaker this month will be Luke Vandermillen, going over what's new at RPAG and going over some announcements and where to find some of our content, as well as some new content that you guys all have access to as RPAG members. So take it away, Luke.
Hello, my name is Luke Vandermillen, and this week I'll be taking you through some of the exciting things we have going on here at RPAG. Welcome to the RPAG Scoop. First off, we've sent out some save the date reminders for the RPAG National Conference. Our conference is held every year at the Ritz-Carlton in Dana Point, California, and is jam-packed with educational sessions along with tons of fun by the beach. Keep your eye out over the next few weeks for an RSVP and registration link to reserve your spot at the Ritz. Next, if you're looking for recordings of past RPAG webinars, tutorials on how to use technology, or would like to watch replays of some of our sessions from National Conference, check out the new RPAG YouTube page. This page will be your go-to for any and all videos related to RPAG. You can find the RPAG YouTube page by searching for RPAG 401k in the YouTube search bar. While you're browsing the YouTube page, don't forget to head to our blog site, where we publish written content on all things retirement planning. On this page, you'll find the retirement times, participant memos, summary of webinars, and articles written by some of the industry's best and brightest. You'll even get summaries on our latest tech enhancements so you can stay up to date with all of our new resources. You can access all of this content by searching for insights.rpag.com in your internet search engine. Lastly, we have a new Q&A feature built into the RPAG Advisor portal called Ask RPAG. Here, you can search a bank of previously asked questions by the RPAG community. You can search by keyword or topic, and you can find anything from technology FAQs to ERISA questions here at your disposal. If you can't find a question that's already been asked, feel free to submit a question, and the RPAG support team will be back with you in no time with an answer. And now for some exciting news in the RPAG community. We're excited to announce that RPAG is a two-time Wealthies finalist this year. The Wealthies are presented every year by wealthmanagement.com, and this year RPAG was nominated in both the Retirement Plan Support and Advisor Services 401k Technology category for CEO of the Year for our CEO, Vince Giovinazzo, as well as for Outstanding 401k Technology for the RPAG Rollover Analyzer. With thousands of different submissions to this Wealthies Awards competition, RPAG is honored to be recognized for both of these prestigious awards. Next, a quick happy birthday to the Great Gray American TDF series. We're excited to announce that the Great Gray American Funds Target Date series recently hit the 3-year mark. Over this period, this series has outperformed the Dow Jones Target Date benchmark by over 300 basis points on an annual basis. This series utilizes the same American Funds active management team and glide path, and the participant experience is optimized through a stable value location that reduces downside in vintages near retirement with a stated crediting rating and 0% volatility. This, together with a plan level record keeping discount at Empower, further reduces fees for participants and helps participants secure their retirement assets. Next, if you missed our recent webinar with Thrive, check out the recording on either the RPAG YouTube page or insights.rpag.com. In this webinar, Thrive CEO David Krasnow unveiled strategies and data designed for employers to retain young employees. If your employer clients are wondering if their benefits are currently up to par with their competition, this webinar is a must-watch, as David Krasnow unveils how Thrive can help your employer clients retain their talented young employees. We've also just conducted an exciting webinar announcing our new partnership with Venrollment. Check out the recording of this webinar to watch Venrollment CEO Justin Terrington demonstrate how Venrollment uses cutting-edge technology to transform the employee benefits communication experience. This game-changing platform is now available at an exclusive discount for RPAG member firms. Lastly, we have a few new items in the Resource Center to help you with your advisory practice. First off, a capital preservation and cash equivalent funds presentation, which you can find in the Content Marketing Plan category in the Presentation subfolder. a small business retirement solutions guide, which again is in content marketing under the flyers and one-pagers subfolder, a budgeting worksheet, which can be found in the participant services category in the participant education subfolder, and a 2023 retirement plan limits one-pager, which is found in the fiduciary compliance and plan design category in the plan limits subcategory. If you have any questions on any of the resources I touched on today, or on how to best utilize the RPAG tools and technology, feel free to reach out to our support team at 949-305-3859, or shoot us an email at support@rpag.com. Thanks for your time today, and look forward to talking to you real soon.
So following up with Luke's point about the conference, the registration links are now open. And if you did not receive an email about that, make sure that you reach out to support@rpag.com. So next up is going to be our investment update with Matt Giovinazzo, and he's going to be giving you the CIT updates that RPAG members have access to, along with BlackRock's weekly commentary. He'll be doing a little bit of a deep dive into that, as well as giving the announcement for the TD Brief podcast episode number 7, and a little bit of an asset class review. Without further ado, let's hand this over to Matt.
Hi, everyone. Welcome to the investment portion of this week's RPAG Scoop. I'm Matt Giovinazzo with RPAG and FlexPath. I have a few exciting, I wouldn't say announcements, but updates and kind of reminders as far as we've had a lot of updates and announcements over the past few weeks and months of new content, resources that you can use, etc. So I'm going to do a quick, interesting take on the markets and then kind of just quickly rehash on what those are. That way you can decide what's most relevant and of interest to you, and then go find out more information on those different solutions and ideas. The first thing that I wanted to touch on real quick has nothing to do with us, but is a quick, interesting take on the market. So the two pieces that I've kind of tuned into on a weekly basis are the BlackRock Investment Institute commentary and JP Morgan weekly commentary. And I think you have this general consensus in, I don't know if it's the markets or individuals or companies, that obviously we've had a crazy interest rate and bond environment over the last few years, with 2022 bonds really melting down, and Q1 bonds unexpectedly, or not unexpectedly, but did rather well from a performance standpoint, and Q2 bonds are going to end up down again. I think the general consensus is that rates are going to go down this year or next year, and really the Fed is going to come to the rescue with the first sign of market issues, right? Or really economic issues even. BlackRock has an interesting perspective on this. The quote here: "We've been saying since the end of 2022 that rate cuts this year would be unlikely as inflation sticks around." The other quote that they make, they've really made for some time and held to, is central banks are unlikely to come to the rescue with rapid rate cuts and recessions they engineered to bring down inflation to policy targets. If anything, policy rates may stay higher for longer than the market is expecting. What they're basically saying is, look, the Fed is almost intentionally inducing a recession here. So why would they then come in and come to the rescue like they have done in the past? The first sign of any kind of issues in the markets or economy, they want to spur growth, so they're going to lower rates. In this case, in order to get inflation under control, they are rising rates very rapidly, partially to stunt the economy and growth in order to get inflation under control, right? So I think it's an interesting perspective that might not happen as soon as everyone is anticipating. And I think you've already kind of seen that, and that is what basically they're saying here. Hand in hand with that, something else in the fixed income world that people are talking about is inverted yield curves. And we know what that means or has meant in the past in terms of predicting a market drawdown or a bear market. I think one other thing to think about is, how does the yield curve correct itself? So you have two ways of that really happening and getting back to normal. One is the short end going down, which is controlled by the Fed through them basically setting the Fed funds rate, of course, right? That gets the short end down, and now you have an even or a normal sloping yield curve. The other is the longer end of the curve going up. So basically, if the Fed doesn't come to the rescue as much or as soon as everyone thinks, and the yield curve eventually or inevitably corrects itself, what does that mean? It means that long-term rates are really going up, and that can have just as much or not more pain For bonds and investments that we would put in a 401k plan, something like the ag, because there's a lot of that longer duration exposure, whereas there's not a ton of like that. Fed funds rate isn't impacting it that much. So I think just an interesting thought and take that you don't hear about a ton. Now, getting to a few RPAG updates, I recorded a webinar called Solving the TDF Scorecard Methodology. This was probably 2 months ago. That's in the Video Learning Center. I would encourage you to check this out for two different reasons. One is it does, I think, I am biased, a good job of reviewing how RPAG views target date funds uniquely. So we use custom benchmarks and custom peer groups, for example. You should probably understand those both for your analysis presentation to clients in case they ask questions. It's also great for a differentiator and bringing a unique angle to either a prospect or a client that frankly other systems do not. So there are certainly target date fund applications there, and I do go into kind of sales opportunities, how you should approach this from an analysis perspective, tools we offer you to help with target date fund oversight, selection, compliance, etc. Maybe the most important was really the last 10 to 15 minutes of that, which has nothing to do with target date funds, but I basically go into general scorecard differentiators and kind of tips and tricks on the normal scorecard and metrics. For example, the first point, the first style point you see in any scorecard, did you know that those numbers have meaning? And if you can't look at those numbers and understand the positioning of a fund, it's like value, growth, large, small positioning, then it might be worth you tuning into that webinar. Again, both for your analysis and so that you're not caught flat-footed if a client asks you questions. There's some really cool stuff in there. Also, the way that we do peer ranks, you ever notice how our peer rank numbers are very different, maybe very different than Morningstar's peer ranks? There's a reason behind that. And I think this does weave a very strong story for the RPAG scorecard that you can be telling clients and prospects. So I encourage you to go check that out. Another resource that we started, or really an ongoing resource, is our TD Brief. So this is kind of, I call it a podcast because I'm trying to be Joe Rogan, but it's really just a monthly webinar series that's very short in nature, usually 5 to 10 minutes on something related to target date funds. It could be just scoring basics like I just talked about, participant behavior, 2022 performance of the overall markets and how that's affected different target date funds, summarizing different research articles like the Sway research and Morningstar white paper. So instead of spending an hour reading that, you can kind of hear from Kellen on his take and summary on that. I just did one on differentiating passive target date funds, which is becoming more and more difficult as so much of the focus is on fees and finding 1 basis point savings. So hopefully this is a great resource for you. Something that can just be fun while you're working out, commuting, whatever the case is. We've got some key takeaways here. So again, short, sweet, and I think very educational. 2 updates from a technology and reporting standpoint. Hopefully most of you are familiar with the asset class review report. You are likely familiar with the active asset class review, which is a great report, which gives you everything from like rolling peer rank charts, and you can put in 3 or 4 or more different funds within an asset class and stack those up against each other and look at calendar year returns and a bunch of different data. It's great. The passive one is something that frankly I never used and almost didn't know existed, but the enhancement that we made to this report that can really come in handy for you is for passive funds. We're now not just showing the benchmark that the fund is scored against, which for a US equity fund is the Russell benchmarks, but we're also showing S&P and CRSP. So in particular, this is helpful for a fund like Fidelity 500 that's obviously benchmarked to the S&P, but scored against Russell. That might not affect, its score because those benchmarks are so similar, but you do see this in particular with small cap, mid cap, and completion indices, kind of SMID cap. It's just helpful to have this to provide a depiction of the tracking error for that fund, again, versus the fund's actual benchmark. As you can see here, you could reassure a client, yes, look, there's been some tracking error, although it's on the upside, might not be a concern. Hey, look at how closely this fund is tracking versus the S&P 500, which is its benchmark. So a great enhancement there. The other enhancement that our CIO, Jeff Elevander, touched on in last week's scoop is the strategy equivalent. So as most of you know, RPAG has now tied CITs to their strategy equivalent. So in an output of an investment review or a scorecard, you would see that CIT strategy equivalent, basically the mutual fund clone, right below it, so that your reporting on CITs, your ongoing due diligence, et cetera, is not affected. That's pretty much just been the scorecard, and we've slowly been making enhancements over time. Now that strategy equivalent score shows up in the score history and the total cost analysis. You can run an asset class review on a CIT. It shows up in the style box. That's probably the best addition, in a bunch of other places. The most recent now is in the fund lookup tool. You'll be able to see the strategy equivalent score as well as the consideration step of the fiduciary investment review. So just know, if you notice in the last 6 months, after the SEC rule on not being able to link different share classes to each other, which is a nightmare. If you notice that the fund lookup tool and the consideration set wasn't showing scores for the CITs, that is now corrected. And we're continuing to roll out enhancements there. One that I know we're working on it, for example, is the summary of considerations page. And I think the plan allocation by investment type. So ultimately, it'll be kind of uninterrupted and seamless, just like it was in December before that rule took effect. So strategy equivalent scores, things continue to go well there. Very quick update for you from an investment innovation standpoint in terms of the actual solutions. These continue to be great differentiators for RPAG members and bringing something to the table that is unique. I always, I'm trying to approach it from that angle, understanding that the role of an investment advisor is becoming more and more commoditized and frankly, just more difficult for you to differentiate yourself, which is why, yes, a lot of what we're doing on the technology side and kind of talking about, you can talk about peer ranks and how we do that differently. That is meant to differentiate you. A lot of the other kind of enhancements to our reporting is designed for your efficiency. That is why we're investing so heavily in this investment innovation suite, so that you have solutions you can take to a client and prospect that frankly your competitors don't have, and you have ways to save that your competitors don't have. And that's really what we're doing with the CITs here. So update from an inventory standpoint, JP Morgan US Value is a strategy that, or a CIT that's been around for some time. It's kind of sister strategy, equity income, and is an immensely popular strategy in the DC space. This is really the same, or it's not really, it's the exact same management team and process. The only difference is there's no dividend requirement for this strategy, whereas equity income there is. So you have a wider available investment universe that's really translated to slightly better returns for this fund. So one, this CIT is a great replacement candidate for obviously the US Value Mutual Fund, also the Equity Income Mutual Fund. And given that equity income is closed, this is really the only option for new placements going forward. JP Morgan Large Growth is a terrific option that is very new. For the CIT standpoint, we have a breakpoint built in, so this is likely to drop another 2 basis points to 39. It's 40.5 right now, so 38.5. Once $2 billion is hit, we're already at $1 billion, so I'm guessing probably middle of the way through 2024. So that'll have another fee increase. Allspring Mid Value, great strategy, scoring a 10 that will be available soon. Janus Enterprise is a terrific mid-growth option. So our mid-growth 2 CIT scores a 7 right now. It's very, very likely that this fund is going to gain its 2 peer rank points back. It had a short kind of, frankly, underperformance during the COVID rebound, since there really was a 3-month, 2-month COVID drawdown, and they were positioned very defensively throughout that period. Obviously, with the drawdown last year, they made up for a lot of that defensive positioning, continued to do very well. So all their performance numbers look great now, and a very popular strategy, and one, again, that's going to continue to score well, especially even improving next quarter. Columbia Small Value has really rebounded in scoring, continues to be a great strategy. Neuberger Berman Small Growth is a new option, scoring a 10, 58 basis points. American Funds Europac, relatively new, 41 basis points. For the CIT, since managers choose their benchmark, this is scored against the ACWI ex-US benchmark, which is, of course, a blend, and their prospectus benchmark. The mutual fund, Morningstar categorizes it as international growth. So it's scored against IFA growth, so it scores a little bit lower. So that is one of the potential benefits of using a CIT, isn't just the 5 basis point savings, but it is being scored versus American Fund intended benchmark, which is ACWI. BlackRock Emerging Markets is a new option that'll come to market soon. 24% discount, scoring a 10 at 62 basis points. From a target date fund standpoint, Retire Pilot is our newest co-manufactured BlackRock target date fund that's available at Principal. That's leveraging all of BlackRock's kind of flagship asset allocation methodology with a stable value addition. So Principal in particular, the crediting rate's quite strong at 4.85%. The goal is really to, from that stable value piece, replace the short and intermediate term bond portion, eliminate some of that interest rate risk and interest rate volatility, and provide guaranteed returns of close to 5%. So a great solution there that qualifies for the same record keeping discount as Principal Lifetime Hybrid target date funds. We're going to soon launch a Principal American Fund solution that kind of utilizes the same approach that we already have with Voya and Empower, same record keeping discount. On the note of Wilmington Trust American Funds, that series just hit its 3-year track record. This series has not only outperformed a common target date fund benchmarks, but specifically the American Funds Mutual Fund series by quite a wide margin. Speaking of other notable milestones, our multi-manager blend with Empower, My Retirement Path, often gets overshadowed by its passive kind of sister series, Index Select, which is the same thing, just obviously passive. This is best in class multi-manager blend, My Retirement Path, that is. And those multiple managers have added 74 basis points of annualized alpha over the last 3 years. This series just hit its 3-year number. So happy birthday. But a great option for those of you that prefer a blend or an active. Net of fees, again, 74 basis points of outperformance, really showing what the RPAG scorecard can do. To speak to the strength of these various series, we've put together this chart showing the top 10 target date fund families by assets and our various Empower solutions in particular. As you know, we have kind of open architecture solutions available at any record keeper. And like Voya has My Compass Index, not the multi-manager active, but this is a good representation. And obviously they're a prominent record keeper. But anyway, sorting in descending order, also with Sharpe ratio here. And you can see how strong that My Retirement Path solution in particular that I just mentioned is from a return standpoint, also a risk-adjusted Sharpe ratio standpoint. Even the American Fund solution I mentioned here, and here's the mutual fund series kind of below it, so you can see the outperformance. But this is also color-coded by risk level here to kind of show, obviously you would expect aggressive TDFs to do better than moderate, than to do better than conservative, but just to kind of give some context there. So we're really happy that, frankly, not just these solutions are doing great, that's their goal, but that you have a lot of different options, right? That's really the goal here, is to give you different levers that you can pull and to allow the target date fund conversation to be more consultative for you. Do you want something that's completely agnostic with no stable value or kind of favoritism to a record keeper's funds? You have FlexPath Index and Index Plus. Do you like a very aggressive target date fund that has terrific returns and a long-term track record? You have Wilmington Trust T. Rowe Price, which is a clone of the mutual fund, just at a share class or an expense that normally a plan needs 500 million for. It's a great story for you there, right? If you like American funds and active, you have that option. If you really want to drive down fees and get the lowest possible record keeping, where you see a record keeper listed, you are going to get a record keeping discount. I think in particular, the multiple glide path approach gives you a unique really story, right? The industry's trending to towards personalization. You have something that accomplishes this in a participant friendly and a very low cost manner. It also puts you in the driver's seat on the glide path. This allows you really to control, hey, do I want a conservative glide path for this plan, a moderate or an aggressive? You can choose that one that the plan gets, right? Whereas if you're choosing T. Rowe, you're probably doing that because they do have an aggressive glide path. But let's say you like their active funds, but you want it to be a more conservative glide path, you don't really have that option, right? So with the BlackRock family, really the FlexPath family, it does put you in the driver's seat more. It allows you to be more consultative, frankly. And then of course, kind of obviously 98% of plans end up adding all three. So it's not just you're choosing the best one for the plan, but how is that going to suit the needs of all the participants in the plan, right? They probably have very different risk tolerances and savings rates and salaries and account balances and comfort with risk and all that. And that is really the whole idea behind the multiple glide path approach. But hopefully that's a helpful update from a product standpoint, as well as what we're doing from a reporting and a technology standpoint and a fresh take on the markets. We'll see you soon. Thank you.
All right, so that was a great overview by Matt Giovinazzo. So now we're going to toss it on over to our partners at T. Rowe Price, and they're going to be explaining the opportunity that they need to help participants, how they purposely design their portfolios to drive outcomes, and the strong results that they have achieved.
Hello, RPAG members. I'm Jay Kim, National Account Manager for T. Rowe Price. On behalf of all our sales teams, I want to thank you for your continued business and partnership. Over the next 4.5 minutes, we'll hear from Catherine Farrell, our portfolio specialist on our target date team, where she will give highlights of the Great Gray T. Rowe Price Retirement Date Trust that is exclusively available to RPAG members. The Great Gray T. Rowe Price Retirement Date Trust is the first fully active target date solution that is record keeper agnostic, which means this is available on any record keeping platform where trading agreements are in place for this product, and available to all RPAG members at 36 basis points. Please remember to reach out to your respective T. Rowe Price sales representative to learn more. And now, Catherine, over to you.
Thanks, Jay. And thank you to our partners at RPAG for the opportunity to share more about the T. Rowe Price Retirement Trust. I'd like to use our time to talk about 3 things. First, the opportunity that we need to help participants. Second, how we purposefully design our portfolios to drive outcomes. And third, the strong results we've achieved for our investors. First, we understand that participants face several headwinds when preparing for retirement. Saving rates are generally too low. When we look at participant level data, we see the vast majority of retirement savers do not save the recommended 15% of their earnings, even including an employer match. And most participants have lower savings rates earlier in their career, setting up a challenge to build a nest egg that can last throughout retirement. And that retirement time horizon can be meaningful. The probability of one member of a 25-year-old couple living to age 90 is 74%, meaning they'd have 2.5 decades past the typical retirement age of 65 when they'll need their savings to support their spending levels. And maintaining a level of spending is a challenge itself. We know high levels of inflation can meaningfully impact spending needs, as we've seen recently. And over a long time horizon, even a small amount of inflation can eat away at an individual's purchasing power. Over 30 years, for example, a 2% inflation level would mean someone would need 81% more money to maintain the same spending level. Second, on the next slide, you can see that we design our target date solutions to meet those challenges and support our investors as they save for and go through retirement. Glide path design, the mix of stocks versus bonds and how those change over the life cycle is a meaningful driver of outcomes. We thoughtfully balance the need to drive growth throughout the life cycle with a meaningful level of equity, paired with a risk-aware design to mitigate against market risk and volatility throughout a lifetime. Under the hood of the glide path, implementation is important. We use a well-diversified mix of equity and bond building blocks to provide exposure to the global opportunity set of investments. We bring a sophisticated approach, allowing for individual investors to have exposure to a broad array of asset classes that can help smooth the ride throughout their investing journey. Importantly, we use actively managed building blocks to allow for this level of diversification, as there are asset classes that you can't or wouldn't want to use from a purely passive implementation perspective. In addition, we benefit from the global research platform at T. Rowe Price that allows our underlying portfolios to, in aggregate, have outperformed passive benchmarks net of fees over the long term. Lastly, while target date portfolios are great for individuals looking for a professionally managed allocation that they can set and forget, we don't ignore our portfolios and the changing market conditions. We harness the investment insights of T. Rowe Price as a global organization with boots on the ground knowledge of asset classes to make modest, dynamic tactical adjustments, leaning into and out of various asset classes in the short term to further drive returns and to mitigate risk for our investors. And finally, we have managed target date solutions for over 20 years. We're proud to share that we consistently have been recognized by Morningstar for the work that we put into our solutions, including earning a gold analyst rating, reflecting their conviction in our process, our people, and our parent organization. In addition, our performance track record is strong, with high peer rankings and each vintage outperforming their peer average on an absolute and a risk-adjusted basis over the long term. We are focused on continuing to deliver strong outcomes for our investors and appreciate the partnership with RPAG and your clients.
And last but not least, we have Darren Zeno, the Senior Managing Director of U.S. Retirement Distribution for Transamerica, where they stand today and where they're heading in the future as record keepers.
Hi, I'm Darren Zeno, Managing Director and Head of U.S. Retirement Sales for Transamerica. I want to take a few moments to share some thoughts about where we stand today and where we're heading as an organization. Transamerica is an industry-leading record keeper with more than 85 years of experience helping people prepare for the future, and we're proud of our reputation as a trusted provider. We support more than 4 million plan participants as they reach for a brighter retirement, along with the advisors and employers striving to assist them. But you probably already know that. So let's talk about a few things you may not know about Transamerica. We offer a wide range of programs to help employees along their journey to retirement and beyond. Things such as voluntary benefits, health savings accounts, emergency savings accounts, student loan assistance, and a paid time off exchange program. These offerings are designed to help employees manage their overall well-being, physical, financial, and emotional, because we understand that preparing for a comfortable retirement goes beyond saving money. Transamerica is committed to focusing on key areas that we know are important to our advisors, plan sponsors, and participants. In keeping with that commitment, we recently launched Advisor Managed Advice, a service that allows advisor firms to provide personalized investment portfolios to their retirement plan clients. Using our advice services platform, advisors can use the service to make recommendations and outcome-driven asset allocations while offering a 338 fiduciary service to their clients. We are proud of our new participant website, also recently launched and available to all Transamerica participants. From the new homepage, participants can easily find a personalized snapshot view of their priority data, access tools, and educational resources using quick links, and see how they're doing with an enhanced retirement outlook forecast. Of course, listening is a critical part of the process. That's why we've invested in a state-of-the-art voice of the customer process, which allows us to gather feedback from advisors, plan sponsors, and participants. With the insights we receive, we apply our listen, learn, and act service model with the goal of continuous improvement for our customers. Thank you for taking a few minutes with me today. If you already work with us, please know we truly appreciate your business. If you haven't yet partnered with us, I encourage you to take another look at how we can help.
We hope you all enjoyed this episode of the RPAG Scoop. Make sure that you leave a comment, share, and subscribe to our YouTube channel. Thank you guys. Bye.